Hey guys, this is Toby Mathis with Infinity Investing, and today we're going to talk about what Enron taught us about investing. More importantly, what it taught us about proper diversification. And so I'm using Enron loosely here because it was one of these huge companies that had a lot of folks investing in it. And of course, they were cooking their books and committing some fraud. And as a result, a lot of people lost a lot of wealth. But I could substitute in WorldCom, I could substitute in Bernie Madoff, I could substitute in just about any company that went spiking up and everybody was like chasing after it, maybe even Bitcoin, right? We got to be always looking at it saying we don't know. And I'll give you a story to illustrate what I'm talking about. So I have a personal friend and a client from a long time. He was actually friends with my mentor. And this individual was a very successful business person, as in the tunes of hundreds of millions. And he had a company. He brought in something called calling cards in the United States and had a lot of success. And anyway, he was approached by what was at the time the largest company on the U.S. stock exchange. So in all stocks in all of the United States, these guys were numero uno. This is the big one. This is like Tesla or Amazon now coming up, or whoever's the biggest. It's going to be Apple, Tesla, or Amazon right now. There's no way they could fail. And this company came in and said, I want to acquire your company, and bought his company for, hundreds of millions of dollars, almost $1 billion, and paid for it in their stock. And they had restricted shares. Lo and behold, some months after the transaction, who is this guy, my buddy, is Mr. Moneybags now. He's hundreds of millions of dollars. He's never going to have to work again in all of his life. And then WorldCom gets embroiled in a massive scandal, and lo and behold, ends up in bankruptcy. Because he had restricted shares, he could not sell most of what they bought his company with, and he ended up experiencing complete and utter financial devastation. Like you and I would say, hey, he still had millions of dollars. For him, it was absolutely getting his legs cut out from underneath him. And I still speak to him today. I still have dinner with him. I still talk to him all the time. And I tell you what, the rest of his life has always been towards building something else up. He never sat there and licked his wounds. He said, hey, it's a process, easy come, easy go. But you could always see it. It absolutely rocked him to his core. And I always think of him when I think about diversification, because I hear all this time, hey, it's a sure winner. I'm going to put a bunch of money into it. And I always like, whoa, whoa, whoa. If somebody had been talking to him before he did that transaction, they may have said, hey, too much risk. One company, right? Is there a way to diversify some of this? Do you want to sell to somebody else? Do you want to maybe do something else? Do you have other investments? Or is this all your eggs in one basket? And we've seen this over and over and over again. Bernie Madoff was another one. I actually read through just hundreds of the victim statements. At one point, I was doing a deep dive. And I said, what was causing this? And I call it, handing over your responsibility to somebody else. You see this thing, that's great. And this is an earmark of most Ponzi's, by the way. Most Ponzi schemes, they seem too good to be true. It's so great. The first people get in and they're getting their money back and they start telling everybody else, but it's the other people's money that's being paid out to the first people. And of course, the promoter's running off with all the cash. But these people lose their minds and they just start handing it over. Like, you're better with money than I am. You handle my money. And they take over the responsibility and they plop it right onto somebody else. And that's what you can't do. You need to be the one who's responsible for your stuff. And the way you do that is by diversifying it into multiple areas. At Infinity, we really only have 4 areas, like 3 big ones and then 1 little one. 10% of your portfolio should be in cash or cash equivalents. That's going to be things like gold, cash, cryptocurrency, no more than 10%. You're not going all in and dumping everything into crypto because it's the new thing. You're going to have 30% in the stock market. And we prefer dividend producing stocks. We like tried and true value stocks or dividend stocks. We're not big fans of growth stocks, although that's what everybody in the stock market's talking about all the time. We want something that's going to pay you. We want the income stream because we don't intend to sell it. If you want to sell it, then you're going to go after something that's going to go up and you're going to take that quick hit. Hey, yeah, I win something. We want something that's compounding over a period of time. And the easiest way I could explain this is if I gave you $1 million or a penny that doubled every day for a month, which one would you take? A lot of you guys would say the $1 million, obviously. No, that million or that one penny, if it compounds, doubles every day for a month, is going to be worth about $5.3 million at the end of a month. We want the revenue stream. We want the compounding. We want the long-term wealth. And that's what we focus on there. We also want to have 30% in real estate or real estate equivalents. That could be REITs, that could be single-family properties, that could be manufactured homes, that could even be private placements in real estate. But we want you to be exposed to the real estate market because historically, the stock market and real estate just go like this. And not real estate like as in your house. Your house is way down here. Real estate, that is cash flow real estate, goes up with the stock market. Gold and your house are down here. The other one's growing exponentially. So we go into the stock market and we go into real estate. That's it. You may have some crypto, you may have some gold, but that's cash or cash equivalents because it's not paying you anything. What we care about is things that are producing income for us. So when we go into real estate, it's cash flow real estate. We're not speculating that a property is going to go up in value. We're not flipping houses. What we are doing is we're focusing on houses that we can buy once and then get a perpetual income stream for an infinite period of time. The third area that we go into is the managed portfolio. When I say managed portfolios, it could be a money manager, 1% or less to manage a portfolio, or it could be a hybrid. It could be private placements. It could be something where somebody else is in certain amount of control and management of that portfolio. So it could be something like this is, again, 30% that you're actually giving up control to somebody else. And the reason I say do that is because in case you are wrong, in case you make a mistake, in case your judgment is absolutely whacked, your entire portfolio is not at risk. You actually have this other money set aside up here that then is going to make sure and rescue you and protect you. Plus, when you have a money manager, they're great for information. You can have conversations with them. You can figure out what their methodology is, what they're thinking on the markets. And it's just constantly adding another tool to your toolbox when you're contemplating other investments. So we have, again, 10% in cash or cash equivalents, 30% in the stock market, 30% in real estate, and 30% in managed money. You follow that, you're going to have a ton of, you're going to be diversified and you're going to have a ton of success. So going back to our friends at Enron and all the other companies, that's why we do it this way. No matter how good something looks, no matter how sure a thing it is, we just don't know. Nobody has that crystal ball. What we do know is that things happen, and history has showed us that the market shakes out. The real estate market, I lived in Las Vegas in 2007. And we lost 75% of the values of our real estate. It was a great buying opportunity. What they say is, when others are fearful, be greedy. That's an old Buffett quote. When others are fearful, be greedy. When others are greedy, be fearful, right? There's going to be fluctuations in the market, but you're able to handle it because what was really interesting is all during that big, huge downturn, the rents never went down. The rents continue to increase on our rental properties in Las Vegas. So it's really bizarre when I look back and I go, that was just weird. The values took a shot. And then BlackRock came in and started trying to buy up everything because the rents were still great. People still had to have a place to live. It's just we had this huge foreclosure, epidemic that really hit a lot of cities. And it's not just Las Vegas. It was all over the country, right? But the cities that were kind of high flying were the ones that got hit the hardest. So the Phoenix, you think about places in the United States, just about everybody got hit. Seattle, Los Angeles, San Francisco. Well, San Francisco slid off it pretty quick and started skyrocketing again. But everybody got hit pretty hard. And you were able to handle it as long as you had that income coming in. When the stock market crashed in 2008, the stock market went down on average. The S&P 500 went down 38%. The companies that we invested in, the companies that we recommend went down 18%. And that was the dividend producing companies. So it wasn't completely immune, but those companies were still kicking out dividends. What I always look is that was a great buy opportunity because they all recovered in the dividend kings, just one little sector, about triple performed the S&P during that recovery. And that's because they didn't get hammered down because they had that income flow that was still coming out. So they didn't get beat up when the market pulled back. For all those who are waiting for the market to pull back, or you're doing the doomsday, this is a crazy market and it's going to, it's going to crash. Okay. Then the last time it crashed, here's the companies that did the best. Maybe we should be looking at those instead of a whole bunch of growth companies. And again, I'm not telling you not to do the growth companies. I'm saying diversify. Do both. Do as many things as you can so that you're spreading out that risk, and it works out great for you. And so what we've seen over the years, and I've been a tax attorney for over 20 years, and as I'm watching this and looking at our clients and you're seeing, who's successful over a long period of time. I have plenty of clients that I've had for 22, 23, 24 years. And the success that they have is for the very reason, for this precise reason, is that they didn't have everything in one basket. They didn't bet everything on one horse. And frankly, they didn't even gamble. They were always constantly getting funds out of their investments during the whole time. And once you learn to do that, and we will teach you that in Infinity, absolutely. Once you learn to do that, then you can sleep at night. Because no matter what the market's doing, no matter what this company, that company, or another company does, you don't have to worry about it because you're not betting at all on Enron.